So you're thinking about dividend stocks, getting paid while you sleep. Passive income? Man, it sounds like a dream. But here's the truth most folks won't tell you. High yields can be a trap, but they can also be a treasure. And the key is knowing how to tell the difference. So today I'm going to show you exactly how to analyze a dividend stock so you don't end up stuck with a falling knife, but instead hold something that pays you forever. And we're going to do it with a real life example. Part 1. Why high yields can be dangerous. Look, mathematically, high yields look sexy. I mean, who wouldn't want 8% or 10% returns? But here's the deal. Sometimes high yields happen because the stock price has crashed. And it crashed for a reason. The dividend might not last. Imagine this. A company pays $4 in dividends. Stock price drops from $100 to $40. Now it's a 10% yield, but the company's dying. And that's called a dividend trap. But not all high yields are traps. Some are designed to pay more, like REITs, for example, Real Estate Investment Trust, BDCs, MLPs. Today, you're gonna learn how to separate the traps from the treasures. Part 2, the metrics you gotta know and why they matter. When you're analyzing a regular dividend stock, not a REIT, not a BDC, these 6 metrics will save you from getting played. Let's break them down step by step. Number 1, dividend yield. Dividend yield is the percentage of the stock price that gets paid to you yearly in dividends. For example, if a $100 stock pays $4, the yield is 4%. The higher the yield, the juicier it looks. But high yield alone can be a trap. If the yield is too high, 8 to 12%, the stock price might have crashed, which could mean trouble. Some would say that around 2 to 4% are healthy companies. But me and you want higher yields than that. So only if the business can sustain it. That's why we need to learn other metrics. Second metric, the payout ratio. Can the company actually afford the dividend? The payout ratio is the percentage of the company's earnings that is paid out as dividends. For example, if they make $10 per share and pay $5 in dividends, then the payout ratio is 50%. Why this matters? This tells you how safe the dividend is. The danger zone, payout ratio of over 80%, means they're giving almost all their profits away in dividends. And if their earnings drop even a little, they might have to cut the dividend. A healthy range would be under 70% for most companies. Higher can be fine if the business is super stable. Some companies like REITs are actually required to pay a substantial amount of their profit into dividends. But REITs are attached to real estate. And if you've been watching my channel, then you know how much I love real estate and that they are great investments. Third metric, earnings growth. Is the pie getting bigger? How fast are the company's earnings growing? A company needs growing profits to keep paying and raising dividends. If profits are shrinking, the dividend is going to get squeezed. And the catch? No growth equals dividend is in danger long term. Fourth metric, the free cash flow or FCF. Does the company actually have the cash? Free cash flow is the cash left over after a company pays its bills and invests in itself. And why this matters? Dividends are paid in cash, not earnings on paper. A company can show profits but still be cash poor. So what to check? Does the free cash flow cover the dividend? If not, it's like your broke cousin promising to pay rent next month, but you know they're lying. Fifth metric, debt to equity ratio. Are they drowning in debt? Debt to equity ratio measures how much debt the company has compared to what it owns. Too much debt? It's risky. When interest rates rise or business slows, they might have to cut dividends to pay off lenders. And guess what? Lenders always get paid first. Shareholders are last in line. For most companies, having debt under 100% of their equity is solid. That means the company isn't leaning too hard on borrowed money. Some industries like utilities or telecoms can get away with more debt because their cash flow is stable. But for most dividend stocks, the lower the debt, the safer your dividends. Another metric, dividend growth history. Have they been consistent? Look, anybody can pay a dividend once. That's easy. Even your ugly ex-boyfriend can do that. The real test is whether they've been raising that dividend year after year, even when things get ugly, like your ex-boyfriend. If a company's been growing their dividend for 10, 20, 30 years, like those dividend aristocrats. By the way, a dividend aristocrat is a company in the S&P 500 that has raised its dividends every single year for at least 25 years straight. Think about that for a second. That means these companies kept increasing payouts through recessions, wars, market crashes, pandemics, all of it. They aren't just paying dividends, they're also growing them year after year. And why this matters. If a company can consistently raise dividends for 25 plus years, they're probably financially strong, well managed, and have a business model that lasts. It's like finding that friend who never misses to give you a birthday gift every single year for 25 years. You can trust that friend. A few examples of dividend aristocrats are Coca-Cola, over 60 years of raising dividends. Procter & Gamble, ticker symbol PG. Think Tide, Gillette, Pampers, products that people use every single day. Over 65 years of dividend increases. Johnson & Johnson, healthcare giant, from Band-Aids to pharmaceuticals, over 60 years of raising dividends. PepsiCo, not just soda, snacks too. Frito-Lay, over 50 years of dividend growth. 3M, the makers of Post-it notes, Scotch tape, N95 mask, over 60 years of raising dividends. If a company has cut their dividends before, that's a huge red flag. If they did it once, there's a good chance they'll do it again to you, to their shareholders. Always check their track record. If they've kept paying through tough times, that's the kind of company you want in your corner. Part 4. Real example. Breaking down Realty Income. Alright, time to get our hands dirty. We're going to break down Realty Income, ticker symbol O, aka the monthly dividend company. This one's a fan favorite in the dividend world because it pays dividends every single month. But we're not just going to take their word for it. We're going to check under the hood. So let's start with the yield. Right now, it's sitting at about 5.6%. That's not wildly high like those sketchy 10%ers. But it's solid. It tells me they're not overreaching just to attract desperate income chasers. But can they afford it? Their payout ratio right now, based on FFO, funds from operations, is around 75 to 80%. For a REIT, that's where you want it. Not too stingy, not too reckless. They're paying you well, but still keeping some cash in their pocket. Now let's talk about growth. Realty Income is not a growth rocket. You're not going to wake up and see this thing up 20% overnight. But that's not the point. They got steady, slow growth. Their free cash flow, or in REIT terms, FFO, is strong. Steady cash rolling in month after month. And that dividend, comfortably covered. No sweat. What about debt? Yeah, they got some. REITs almost always do because the real estate industry thrives off using leverage. It's how they buy their new properties. But Realty Income keeps it manageable. They aren't out there over leveraging like some dude maxing out his credit cards to buy fart coin. They got it under control. Now, dividend history, this is where Realty Income flexes. They've raised their dividends 117 times since 1994. Never cut it. Even during 2008, when the world was ending, when real estate was toxic, even in 2020 when everything shut down. Every single month, like clockwork. That's trust right there. But yo, numbers only tell half of the story. Here's the vibe check, the intangibles. What is Realty Income's moat? They own retail properties, but not the mall shops getting killed by Amazon. We're talking essential businesses like Walgreens, 7-Eleven, and FedEx. Places people go to no matter what. They sign long-term leases, which means predictable income. It's like having tenants that pay on time, every time. But the industry's health, retail real estate can be sketchy. We've seen what Amazon did to malls. But Realty Income's smart. They stick with businesses that don't go digital, places people still want to walk into. And their management? These guys are conservative. They don't take wild risk. They survived the dot-com crash, the Great Recession, and COVID, and still kept that dividend rolling. They don't just talk, they prove it. Now let's talk risks. If interest rates stay high, real estate takes a hit. Borrowing costs more, growing slows, and that's just facts. But Realty Income is diversified. They own properties across different industries and locations, so one storm doesn't sink the whole ship. Bottom line, Realty Income isn't flashy. It's boring, but the type of boring that pays, unlike your baby daddy. That's why it's one of my go-to examples for a safe, high-yield stock. That's in my portfolio and always in my watch list. So is Realty Income a good dividend stock? For someone looking for consistent monthly income, yes. It's not gonna make you rich overnight, but it's steady. And the key takeaway? Don't chase yield alone. Analyze the numbers, the metrics, and the story, the intangibles. Find companies that can keep paying you even in bad times, like your loyal spouse who stayed with you even when you were alcoholic. So next time you see a 10% dividend, don't just get hyped. Ask questions. Run the numbers. Look behind the curtain, because passive income is beautiful, but only if it actually lasts. This is the secret sauce. For more investing, finance, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.